685, but then the transactions start on 686, 687, 688, 89, and you can see these pieces. So, exercise 17-3 says, at Rocco State University, tuition and fees assessed total $3 million. 80% is collected. Scholarships are granted for $100,000. $50,000 is expected to prove uncollectible, and $20,000 of the scholarships are waivers for employees. So, I'm going to do this in 2 steps. Again, you could probably aggregate this if you wanted to. I'm going to record my tuition, right? I collected, of the $3 million, I collected 80% of it in cash. The rest is going to be in accounts receivable, right? And you're going to have, as we talked about before, you're going to have a subledger that shows all the students that owe that money, okay? Second part of number 1, you're going to record the money that is deducted for scholarships. Now, in the university system, we're required to report net tuition, which means tuition and fees net of scholarships. So these revenue deductions, in essence, scholarships function as, in essence, a contra revenue account, per se. So rather than having expense here for scholarships, we have revenue deduction. And that's actually how we record them. We actually record negative revenue for scholarships. If that makes sense. It's just the way that we're forced to report. Okay? So scholarships, money spent on scholarships are not technically expenses. They are contra revenue or revenue deduction accounts. Okay? So you record the $100,000 scholarship piece here, the $50,000 uncollectible accounts as a deduction to revenue, and this $20,000 is an expense because it's technically a benefit, right? In number 1 it says $20,000 of the scholarships are waivers for employees. So those are benefits. So if you work for a university, oftentimes, not probably 100%, but most of the time, there's some kind of tuition remission benefit. Okay? And then you have the offset to accounts receivable, because that's what this reduced. Right? Does that make sense? Yes, ma'am.
Just a quick question.
Yeah.
When you get a break on tuition because you're an employee,
Yeah.
is that considered a taxable benefit to you in your paycheck?
That's a good question. If you are doing undergraduate work, it is not at this point. If you do graduate work, it is taxable over and above $5,250 according to the IRS. Now, that goes away. That goes away as of January 1st of 2013, unless Congress and the President come to some resolution on this fiscal cliff. That's one of the tax benefits that's scheduled to go away. Okay? And technically, any employer, not just universities, can give that benefit, right? Can reimburse tuition. Now, there are some caveats to that. Even graduate tuition can be deducted on your taxes. You're testing me. You have to prove that earning that degree is essential to you keeping your job. If you can prove that, you can deduct those. There aren't a lot of those deductions that happen, because there aren't a lot of places where they say to you, you have to get a master's degree or you're fired. There are some, it happens. But that I think is the only way you can deduct those other pieces for graduate tuition. There are ways to do graduate loans. There are a number of companies that will reimburse for education via loan rather than via just a benefit expense, if that makes sense. So they'll give you a loan, you work that loan up. When I was in seminary, there were a number of folks who, in the United Methodist Church, if they were going to school to get ordained in the United Methodist Church, they could sign an agreement that they would go back and serve in ministry in that district. And they would serve for so many years, and that loan that they were given to finance their education would be forgiven if they served 5 years or 3 years or 7 years or whatever it was. Okay? And if they didn't, they had to pay it back. Right? So it's generally called a service loan.
It happens for doctors too.
Yeah. It happens in different industries. It just depends on how the company wants to set up or encourage education, right? Because, well, you could set up a contract and require someone to stay, but generally speaking, there's going to be some way to break that contract and some penalty. That's the way of setting up the penalty, right? So that if you as an employer pay for a master's degree, right, you have some way of either keeping that employee or getting your money back, right? You didn't just fund their degree and then see ya, right? Got a free degree, yippee, okay?
Actually, our company doesn't require you to stay a day past you finishing that class.
Yeah, and some companies do that. Now, is any of, do they tax you on any of that?
Yeah, over the
Okay.
5,250.
Yeah.
Yep. So come the second half
Right.
of the year,
Yeah.
your paychecks go way down.
Yeah, it's taxed just like regular income. Okay. Number 2, revenues collected from sales and services of the university bookstore and auxiliary enterprise were $400,000. So again, probably pretty basic. Record the cash, record the revenue. Okay, it's just sales revenue. Number 3, salaries and wages were paid $1.3 million. Of this amount, $85,000 was for employees of the university bookstore. So they paid $1.3 million of salaries, and because because these expenses are broken out by function, that's why I've broken them this way. That's why they give you that piece of information that says this much went to the bookstore. Because the functional area, one functional area is instruction or education, one functional area is auxiliary enterprises. You can break it into there are other functional areas. If you record depreciation, right, then depreciation would be a functional area. You could make other functional areas. Student support. Let's see, I'm trying to think of the functional areas we have. We have traditional instruction, AP instruction, academic support, public service, student support, auxiliary enterprises, institutional support. So those are some of the different functions, right? So when you report on that, there are different reports we have to file and say, this is how much we're spending to educate students specifically. Even though that's our overall goal, there are certain expenses that are attributed specifically to student support, right? As opposed to paying me, the accountant, you know what I mean, who, yes, in an overall way I'm supporting the students, but I don't generally have direct contact with students as an accountant, right? Okay? Let's see, so that was number 3. Number 4. Number 4, mortgage payments totaled $480,000. Of this amount, $300,000 was for interest. So you record it just like you record a mortgage payment. You would put this to general educational expenses, which is, in this case, one of their functional areas. Again, you would probably, in the real world, this would be denoted by a number, not a title. Okay. Number 5, restricted contributions for a specific academic program were received, $220,000. So we have cash. Again, we have these restrictions, right? If it's restricted for a specific purpose, it's going to go into a temporarily restricted fund. Okay? So cash restricted for a specific program, we're not given the name of the program, just told that it's a specific academic program. And the revenues, in the book, they've denoted this as a private gift, right? Again, you would have a number, you would have an account code that went with that, not necessarily the title. Number 6, expenses for restricted program were incurred and paid $100,000. You have the expenses, you have the cash that goes out for the restricted program. In practice, you would also have a release, but they didn't generally make you do the releases in this chapter. Okay, right? The releases were what we were talking about in the last chapter. Release it from the temporarily restricted fund to the unrestricted fund, because all of your expenses, whether they're for a special program that has restricted gifts given to it, they're all going to come out of the unrestricted fund. Okay, so all of your expenses come out of the unrestricted fund, and then you have to release funds that have come in from the other funds, from the temporarily restricted or permanently restricted funds to cover those expenses. Okay. Number 7, equipment was purchased from resources previously contributed for that purpose. So here we're going to buy equipment and we're going to use cash that was restricted for capital assets. Okay? And you would have a release entry there as well in the real world. Yes, sir?
For number 4, why are we debiting mortgage payable instead of debiting a mortgage expense?
Okay, good question. Why, what do you guys think? What's your answer to that? What am I paying? Okay, good. It's a liability, right? When you pay a liability, think about a for-profit company. When you pay a liability, you don't debit an expense to pay that liability. You just debit the liability, right? So in essence, this is your principal piece, Hugh. This is your interest. So principal payment's never going to go to it. It's never going to hit expense.
Sure, I got it.
In the government fund system, when we were doing the modified accrual accounting, right, we would record this payment as an expenditure.
I think my brain's still in that mode.
Sure. So we would record it as an expenditure, but the difference, the adjustment, right, to get back to accrual is that that's not an expense. That was part of those adjustments that we were looking at when we were looking at the government-wide statements and things like that, right? Moving from modified back to accrual and back and forth. Okay? Seems like creating a lot of extra work to employ people that, whatever. Okay? Any other questions on this problem?